Welcome to Books in Brief.
Today, we're embarking on a massive and really rapid global journey. We're guided by the essential insights in the book The Almighty Dollar by Dharshini David.
And our mission here is to take the overwhelming complexity of the global economy and make it feel real for you. We are literally going to trace the incredible chain reaction that's set off by a single dollar as it moves across the world.
Right, to show you how these seemingly distant global systems are actually deeply personal.
The book asks these questions. They're just so central to the modern economy.
Yeah.
Like, why is it that we can afford so much more stuff, clothes, electronics than our grandparents ever could, but at the same time, we're less likely to actually own a home?
Yeah, why do these massive global forces feel so opaque, so hard to grasp? This deep dive is really all about pulling back that curtain.
And to make it feel immediate, the book gives us two archetypes. They're sort of the two poles of globalization. First, you have Dennis Granger, a retired British bank manager.
Right. His life was comfortable, predictable, and then it was just completely upended in 2008 by the first actual run on a British bank in a century and a half.
A century and a half, his entire safety net was just shredded by decisions made thousands of miles away.
And then on the complete other end of the spectrum, you have Wang Jianlin. I mean, what a contrast. A former Chinese communist foot soldier who just perfectly harnessed globalization.
And became a property mogul worth billions.
Billions. His personal wealth that just reflects this huge shift in global power. I mean, his portfolio is just staggering. He owns the world's largest movie theater chain, a big stake in the Atletico Madrid football club.
So these two lives, they show the global economy isn't some abstract theory. For individuals, it can be a zero-sum game. So today, what we're going to unpack is exactly how a simple shopping trip in suburban America can set off this huge chain reaction.
A chain reaction involving trade imbalances, currency wars, massive international investment, and, the kind of financial recklessness that nearly brought the whole system down in 2008.
It's a dollar story, but it really is everyone's story.
Let's follow the money.
So our journey starts right here in the United States. Picture the brightly lit, packed aisles of a huge Walmart. And we're following the dollar in the hand of Lauren Miller, an American consumer.
She's just buying her weekly stuff, but she also picks up a brand new electronic radio for a price that is just unbelievably low.
And that simple transaction, Lauren handing over her dollar, that's the spark. It's what ignites the whole global machine.
It is, because Walmart's entire philosophy is built on this relentless pressure to keep prices down. Always low prices. Always. The book says they skim off only about 3 cents in profit for every dollar of sales.
Just 3 cents. That is an incredibly thin margin.
It's razor thin. And to maintain that while selling just massive volume, they've had to create this almost singular reliance on the absolute lowest cost imports they can find.
Which for the most part means China.
Primarily China, yes.
Right.
And this is really where economic theory, crashes head on into modern reality.
Right, because you go back to the 18th century guys, Adam Smith, David Ricardo, they had these theories of absolute and comparative advantage.
The argument being that free trade and specialization benefit everyone. A country should make what it's best at, import everything else, and, the consumer wins because of lower prices.
And on one level, Lauren Miller's definitely winning. She gets that cheap radio. But the book forces you to confront the really painful side of that reality.
It does. I mean, that theory has been just catastrophically disruptive for huge parts of the U.S. economy. Since the early 1990s, the U.S. has lost over 4.5 million manufacturing jobs.
And the wealth from those cheaper goods, it just didn't trickle down to the communities that lost their entire industries.
Not at all. The book uses the example of Flint, Michigan, which is so powerful, the birthplace of General Motors.
The engine of American industry.
It was. And then the factories just fell silent. The city's population was cut in half, and the average price of a home dropped to below $20,000.
That's a staggering collapse. It just shows how that textbook theory of free trade, it failed those communities completely.
And this is exactly the point where economics becomes politics. This feeling of injustice, of, communities being hollowed out just for the sake of a cheaper radio at Walmart, it fueled a really strong, often angry political backlash.
We saw it manifest in the push toward economic nationalism, especially in the U.S. Rust Belt.
The most visible example, of course, was in 2018. President Trump announces these 25% tariffs on steel imports.
Right. The goal was to protect American jobs. But what actually happens when you suddenly throw up these huge barriers in a system that's so interconnected.
It's a massive disruption. I mean, tariffs are really just taxes that the consumer ends up paying. So while they might, save a few jobs in Michigan for a little while, they raise costs for everyone else. Lauren Miller's next radio is suddenly more expensive.
And supply chains now are just so complex. That iPhone in your pocket has parts from, what, a dozen different countries? A tariff just throws a wrench in the whole machine.
It does. The book notes that just the threat of tariffs caused China to cancel orders for 60 million tons of American soybeans. It just shows how fragile the whole system is.
So the key takeaway here is that the U.S. consumer's demand for cheapness ends up dictating not just global supply chains, but our own domestic politics.
Absolutely. The U.S. got hooked on cheap goods, and China became the world's primary dealer.
Okay, so let's follow Lauren's dollar. It leaves the U.S., crosses the Pacific, and it lands in China. And China's economic transformation, I mean, it's just been an absolute blockbuster.
Oh, it's unprecedented, all driven by this manufacturing prowess. They saw GDP growth of nearly 10% a year between 1978 and 2012. It lifted over 700 million people out of poverty.
But that success isn't just, organic free market growth. It relies on a very specific strategic financial mechanic.
That's right. It's run by the People's Bank of China.
No.
And they actively manage the yuan's exchange rate. They work very hard to keep the yuan low compared to the dollar.
So what's the mechanism there? Why is a low currency so vital for their model?
Well, think of it this way. When the yuan is low, Chinese exports, like Lauren Miller's radio, are just irresistibly cheap for American buyers. So it's essentially a government-backed way of transferring demand and income from the U.S. to China's factories.
And other countries, the ones that let their currencies float freely, they see this as, well, not exactly fair play.
They see it as an all-out currency war because it artificially makes their own exports more expensive. It puts them at a disadvantage.
So if China is earning trillions of these U.S. dollars from all these exports, what on earth do they do with all that cash?
They don't just sit on it. They build up these massive foreign exchange reserves. And this is where the strategy shifts from just trade to high finance. They invest it. About $3 trillion of it goes into U.S. government bonds.
Into treasuries. That seems a little counterintuitive. I mean, if you have that much financial firepower, wouldn't you want to buy, I don't know, higher yielding assets?
Bold.
Infrastructure.
That's the critical question, and the answer has a few layers. I mean, yes, U.S. treasuries are very low risk, they're secure, easy to sell. The safest asset on earth, really.
But there's a strategic reason, too.
There is. It's all about preserving the status quo. By constantly buying huge amounts of U.S. bonds, China keeps the demand for those bonds high.
And high demand for bonds means lower interest rates across the whole U.S. economy.
Exactly. It artificially keeps U.S. long-term interest rates down. And who benefits from that? Ordinary Americans. It helps keep mortgage rates lower for Lauren Miller, which might help her afford that house she wants.
So China's investment strategy directly props up their own export machine by making sure the dollar-based global system stays stable. It's a self-reinforcing loop.
It's an uneasy mutual dependency. Both giants need the other to stay stable, which creates this kind of strategic financial deterrent.
A financial version of mutually assured destruction.
Pretty much. If China were to just dump all those bonds, yes, it would destabilize the U.S. economy, but it would also devastate the value of their own remaining reserves and absolutely cripple their best customer. They're locked together.
Now, China's economic power, which was fueled by Lauren's dollar, isn't just about making cheap stuff anymore. The book talks about a shift, right?
A huge shift. They've gone from just being the world's factory to being a major global investor, flexing their muscle through what's called foreign direct investment, or FDI.
And this is where we see things like President Xi Jinping's new Silk Road vision.
Exactly. This is a massive geopolitical project. They're funding and building infrastructure roads, ports, railways all across Asia, Africa, and Europe, all backed by Chinese money. The Nigerian railway project is a great example.
And the interpretation of that is pretty polarized, isn't it? Is it economic diplomacy or is it, debt trap diplomacy?
Yeah.
Building bridges or spreading control?
That's the debate, and it's a key one. You see China's appetite for influence everywhere in their acquisitions. They've bought UK football clubs, Hollywood studios, stakes in European power stations, even U.S. retirement homes. They're diversifying and projecting power.
When we talk about development, there used to be this kind of traditional blueprint. The American economist Walter Rostow's 5 stages of economic development.
Right. The idea that every nation goes from a traditional society up to the age of mass consumption, it was seen as the formula.
But not everyone can follow that map so cleanly. I mean, look at India. It's now the world's fastest growing big economy. You've got the huge tech scene in Bangalore.
But at the same time, it is struggling with just massive inequality and huge infrastructure deficits.
And despite all the tech, the book points out that India still runs heavily on cash. 1 in 5 Indians lives on less than $2 a day, and that cash fosters a huge, untaxed, hidden economy, this black money.
And that creates enormous tension because the global economy demands, formal integration. That tension is what led to the Indian government's shock and awe tactic in 2016.
Where they suddenly canceled the 500 and 1,000 rupee notes overnight.
Yep. The goal was to clamp down on that black money and force everyone into the modern, trackable financial system. But the result was just chaos and hardship.
Especially for the rural poor and for millions of women who, keep their savings hidden in cash. It's their only form of financial independence.
Exactly. And the organized criminals, they had already converted their money into property and jewelry, so the crackdown hurt the very people it was supposed to help.
So while India is struggling to get its own currency under control, the U.S. dollar is not only the lubricant for all of global trade, it also acts as a kind of global police force.
That's the real punchline of the dollar's supremacy. The U.S. has, for decades, claimed legal jurisdiction over any transaction anywhere in the world if it involves dollars or even just touches the American financial system.
That enforcement power is just mind-boggling.
It is. The book uses the FIFA corruption scandal as the perfect example. You had high-ranking FIFA officials arrested on Swiss soil, right? At the request of the Americans.
But how could the U.S. claim jurisdiction? It was bribery between non-Americans outside the U.S.
Because the transactions involved dollars passing through American banks. The dollar is the world's ultimate surveillance tool.
So from India and the halls of FIFA, our dollar, now exchanged for euros, heads to Germany. It's funding the retirement of Hans Fischer, a German pension fund manager.
And Hans, looking for a safe, steady return, turns to London for advice. London is described in the book as the world's financial capital.
The ultimate financial casino.
Right. London has always been brilliant at making money out of money, from the coffee houses that became stock exchanges to the East India Company. Its ability to move vast sums of money, often in dollars, is just unparalleled.
And this is the world of the so-called masters of the universe. Traders like the book's Emily Morgan. A culture defined by ambition, huge risk-taking, and the promise of just life-changing wealth.
And that culture of unchecked risk-taking is what led us straight into the 2008 crash. You had these financial products, derivatives, specifically something called a CDO, a collateralized debt obligation.
Which were originally invented to reduce risk, ironically.
To spread it out. But they became these incredibly opaque, speculative tools.
Okay, so break that down for us. What made them so dangerous?
Well, they were built by layering together increasingly risky debt, mainly subprime mortgages held by people who couldn't really afford them, like Paula Miller in Orlando.
Okay.
Then these CDOs were sliced up into different risk levels. The riskiest slices offered huge returns, and the so-called safest slices were given top credit ratings, which misled big investors like Hans Fischer's pension fund into thinking they were safe.
So when U.S. interest rates started to rise and those underlying mortgages began to fail, the whole system just seized up because nobody, not even the regulators, knew what this toxic stuff on their books was actually worth.
The complexity was the problem. And the cure that followed was truly unprecedented. Central banks everywhere just slashed interest rates to basically zero.
And then came QE, quantitative easing.
Right. This highly experimental idea of central banks just pouring massive amounts of new cash into the economy by buying up assets. The U.S. government pumped in something like $3.7 trillion between 2008 and 2016.
So this flood of cash was supposed to stabilize everything. But what did it actually mean for the average person, like Lauren trying to buy a house or Dennis Granger, the retired bank manager?
The book argues pretty strongly that the cure did not benefit everyone equally. All that cash from QE, it had to go somewhere. And it disproportionately inflated the price of asset stocks, bonds, and especially property.
Which creates massive wealth inequality.
Massive. The average British home price, for instance, rose 20% above pre-crisis levels. It now costs 6 times the average wage.
Which puts homeownership even further out of reach for younger people. It just makes the original problem worse.
Exactly. The deep irony that the book points out is that the cure, more credit, cheaper money, it just fed the very addiction to asset inflation that caused the whole mess in the first place.
So our dollar's incredible journey reveals this one central truth. All these seemingly separate events A shopper buying a radio, a Chinese CEO building an empire, a German planning for retirement. They're all intimately interlinked.
It's all connected by these global flows of money, power, and, these very fragile financial systems. The global economy isn't some impersonal force. It's shaped by billions of individual decisions.
So here is the final thought to mull over. Lauren Miller's small act of buying a bargain at Walmart. It reinforces this massive interconnected global system that ensures the dollar's supremacy.
Right, and that very act, while it saves her a few dollars today, unintentionally contributes to the forces like the asset inflation from QE that might make her dream of buying a home tomorrow impossible.
The cycle continues because the addiction to cheap money and cheap goods is shared by everyone, from the suburban consumer to the global financial titan.
We have to understand these connections. They're shaping all of our futures.
Thank you for listening. If you enjoyed this brief exploration of the book, feel free to like and subscribe to our YouTube channel for future episodes. New book insights are coming soon. See you next time.